So you all know the topic for today's session, and without any further delay, I'll move on to the first slide. Can you see this slide? Just confirm that you're able to.
Yes, sir.
Right. Okay, so, look, capitalism is a system in which most of the world lives today. And it has been one of the most dynamic systems. One of the big critics of capitalism is Karl Marx. And Karl Marx has said that capitalism was the most dynamic system in human history. And one of the reasons for why this dynamism has been there is that there has been the operation of competitive markets. And as you know, when markets operate freely, what happens is that producers compete with each other and they are vying for the market. So they are forced to reduce their price and improve their quality if they want to remain competitive in the marketplace. So through this, there is a great improvement in the welfare of consumers, and that is how the dynamic of capitalism takes place. But it is also a fact that in some of the most important parts of human existence, there is humongous market failure. Whether we take water, sanitation, food, health, education, environment, what happens is that when profit maximizing capitalists, see, the goal of a capitalist in a competitive market is to maximize his profits. And for that to happen, the capitalist must be able to meet the costs of his production. And when we speak of capitalism expanding its benefits to larger and larger sections of people, take, for example, where I am sitting. I am talking to you from a tribal village in remote central India. This has been my home of the last 30 years. We don't find, for example, Apollo Hospital or even, the schools and colleges in which you have studied. They don't exist in my area, and they don't exist in most, rural and tribal areas of this country. Why? Because the people here don't have enough money in their pockets to be able to afford the expensive healthcare and education that these private institutions who are trying to maximize their profits will be able to provide. So what typically happens throughout the history of capitalism, I often teach my students, I set them a puzzle. When I start teaching capitalism, I ask them, what is the single most important feature of capitalism, of a capitalist society or capitalist economy? And students are surprised when I tell them finally, after a long session with them, teasing them about what is the most important feature. The most important feature of a capitalist society, of a capitalist economy, which enables its benefits to reach the last person, is actually the state. Contrary to what we have been told by the free market fundamentalists, as I call them, over the last 40 years, actually it is a role of the state which enables the most important sectors of the economy and society to be inclusive in their nature. So whether it's water, sanitation, food, nutrition, health, education, environment, all of these require a very important role of the state. And for today's session, what is important to recognize is that banking is also one such sector. So I will try and explain this in today's lecture. Now, when we look at this word reform, in the last 40 years, there is a lot of emphasis, and all of you must be reading the papers that, how should reform be carried forward? And what does reform mean in all the discussion that has happened? It means the liberalization, privatization, and globalization of all economic activities. So the constant emphasis is on the role of the private sector, on reducing the role of the state. And by doing this, many sectors, whether it's airlines, whether it's consumer goods, the production of cars, the running of hotels, this has led to a great improvement in the choices available to the consumers in India and across the world. And so it has been a highly successful reform program. But as I've argued elsewhere, for many sectors, and my work has been largely about water and agriculture, reform cannot be equated with liberalization, privatization, and globalization. Actually, what we need to do is to reform the state, the functioning of the state in these sectors, for the problems of these sectors to be handled properly. And that's, a large and different subject, which I'm not entering into today. But what I want to also emphasize, therefore, is that it's the same thing as far as public sector banks are concerned. Today, there is a great enthusiasm that we must improve the functioning of public sector banks, and the best way of doing it is to actually privatize them. And what I am arguing today is that this view ignores the basics of economic theory, as well as the large facts of Indian credit markets. So the question today facing the public sector banks is, do we reform public sector banks or just do away with them? What I would call, you want to throw the baby out with the bathwater. And I'm arguing against this proposition. So in order to begin this exposition, I first want to draw your attention to what monetary authorities, let's say the Reserve Bank of India, in India, what are the questions that they have concerned themselves with? They essentially talk about the volume of credit which must be made available by banks to the borrowers and the rate of interest at which this credit must be made available. These are the two questions that have largely concerned monetary authorities. But what I am going to argue is that there are two more questions, which are probably even more important to answer in many historical contexts, including that we find in India. These two questions are, number one, to whom among the potential borrowers and on what criteria should lending occur? And secondly, for what purpose? When the answers to questions 3 and 4 are left to the discretion of privately owned profit-maximizing banks acting in their own self-interest, this only aggravates existing imperfections in already imperfect credit markets. So in many ways, today's lecture is essentially going to explain to you this fundamental proposition, that we cannot leave these very important questions to the discretion of profit-maximizing privately owned banks, because that will go against the national interest, and I will try and explain that. So I'm going to draw you a little bit into two of the great economists of the 20th century. The Polish economist Michał Kaleski first, I'll quote him. And what Kaleski says is, the access of a firm to the capital market is determined to a large extent by the amount of its own entrepreneurial capital. Firms below a certain size have no access whatever to the capital market. A state of business democracy where anybody endowed with entrepreneurial ability can obtain capital for starting a business venture is, to put it mildly, unrealistic. So what Kaleski is telling us is that the credit market, the capital market, will be dominated by large players who have the ability to command that kind of capital from banks, because banks would be averse to lending to players who do not have that kind of capital available to them already. And banking enterprises seeking to maximize their profits would not venture into sectors of activity to which high priority may need to be attached from a larger strategic, social, and economic point of view. Now, this was the Polish economist Michał Kaleski. I'll explain all the propositions I'm making with reference to India in just a minute. But before that, we must listen to the greatest economist of the 20th century, that is John Maynard Keynes. And in his book, which actually revolutionized economic theory in the 1930s, The General Theory of Employment, Interest, and Money, Keynes expresses the same problem a little differently. He goes into describing the two types of risk that affect the volume of investment. The first is what he calls the entrepreneur's or borrower's risk, the risk that is faced by an entrepreneur who's trying to set up a business, okay, who's going to borrow money from the bank to set up a business. Now, what is the risk that she faces? The risk she faces arises because she is unsure whether a business venture will provide the expected yield. Because she has to return the loan to the bank, she must earn as much rate of profit that will enable her to return the loan to the bank. As a borrower, therefore, she would want a low rate of interest, right? Because if her venture especially is a risky one, she cannot be sure that she will be able to make that kind of rate of profit which will enable her to repay the loan to the bank. So this is what Keynes calls the borrower's risk. But the same situation creates the lender's risk. Lender's risk is a risk faced by the bank, because the bank faces the risk of default by the borrower. Because suppose the borrower is not able to return, this can either be voluntary, that is a deliberate, we have had many people in our country, what is called moral hazard, sounds like a very, innocuous kind of thing, but we have had big borrowers, whether it is Subrata Roy or, the Kingfisher owner, etc. These people have borrowed in thousands of crores and run away without returning what they borrowed from the bank. This can be one reason why it happens, or it can happen because, the rate, the direction in which the investment is to be made by the borrower is a very risky one and does not give that kind of return on investment. But from the banker's point of view, therefore, he must charge a rate of interest high enough to induce him, to create the incentive for him to lend the money in the first place. So what Keynes is talking about, and he expresses the resulting social dilemma that arises from the lender's risk being in conflict with the borrower's risk. Keynes expresses the matter somewhat poetically when he says, and I quote, "The hope of a very favorable outcome, which may balance the risk in the mind of the borrower, is not available to solace the lender," unquote. Applying the insights of Keynes and Kalesky to a deeply unequal agrarian economy like India, K.N. Raj, who was writing this in the 1960s, in fact, the biggest case, the intellectual justification in economic theory for the nationalization of banks in 1969 was made by one of India's greatest ever economists, K.N. Raj. And he says, one of the great merits associated with private enterprise is supposed to be that it is enterprising. It is not generally recognized, however, that the very basis of profit making in banking activity sets limits in underdeveloped economies to the enterprise it can display. So what happens is that the profit maximizing bank is not going to undertake the kind of lending that is required by a country which needs to, undertake many investments to build rural infrastructure, to make credit available to farmers. Those for an enterprising bank, it will not be profitable to go into the remote areas of the country to actually lend to the poorest people who are in desperate need of credit. Joseph Stiglitz, who you must have heard of, a Nobel Prize winner in economics, actually won this Nobel Prize for his work on the high information and transaction costs of dealing with a large number of small borrowers that also acts as a major disincentive for banks to go, and work in the remote rural areas of this country. So these are all the reasons why there is humongous market failure as far as banking is concerned, and the operation of free markets does not ensure that most people in the country will have access to credit, which they need for almost every basic need of their life. Now, just to give you a broad global historical perspective, that government control over banking was the norm in most countries in the 4 decades after the First World War. And even after the Second World War, after the colonial period was over, state-led rural finance programs were the characteristics of most countries which were coming out of colonial rule. And if we fast forward to the more recent times in an advanced capitalist country like America, after the financial crisis of 2008, with widespread revulsion against Wall Street and all the misdemeanors of so many of the financial institutions, a public banking movement has taken off there, taking inspiration from the Bank of North Dakota, the only public bank then operating in the US with a highly successful economic record since its creation in 1980. A non-profit public banking institute was set up in 2011 to advance the cause of public banking nationally. Now let's straight come to India and see what was the situation in India before 1969. In 1969, Mrs. Gandhi, who was the Prime Minister, decided to nationalize 14 private banks. At that point, you may not be able to believe this, and I've given the references at the end of the lecture. You can see all the references, and I'll share this presentation with you also. not even 1% of India's villages were served by the private commercial banks when these banks were nationalized. Industry accounted for a mere 15% of national income, but its share in commercial bank credit was as much as 67%. And agriculture, which contributed 50% of the GDP, got nothing from the commercial banks. But after nationalization, the situation rapidly changed and the number of rural bank branches increased dramatically. And by 2019, the latest RBI data indicates that 99% of India's villages with a population of less than 2,000 now have access to some banking services, although we'll go into this as to how satisfactory these are or not. But it is a fact that access to credit became possible for a vast majority of Indians only after the nationalization of banks in 1969. This nationalization fueled India's green revolution, and even today, it is these banks which are the biggest formal source of credit at tolerable interest rates for the poor in rural India, who are otherwise forced to pay anywhere between 5 to 10% per month as interest to usurious money lenders. Please remember, it's 5 to 10% per month, not per annum. It's an unimaginable rate of interest which the rural poor are today paying to these usurious money lenders. And just as I was preparing for this lecture for you, the Reserve Bank of India only last week actually released an index that captures where we have reached in terms of financial inclusion in this country. This government very rightly has been emphasizing the project of financial inclusion. But for the first time, the Reserve Bank of India has come out with a financial inclusion index, the FI index, which captures aspects of financial inclusion like access, how many people have access to the banking system, how many people actually use it, and the quality of the kind of services that they are getting from their banks. The Reserve Bank of India has constructed an index which in a single value captures all of these dimensions of financial inclusion. So the value of 0 means you are completely out of the system, and a value of 100 means you are fully included. That means you are benefiting from all access, usage, and quality in the maximum extent possible. Now, the Financial Inclusion Index value for March 2021, which is the latest month for which we have this figure, is only 53.9, which means that nearly half of India's population is still outside the formal channels of finance, or is unable to access its quality services. So the point that the RBI is making is merely opening bank accounts and transferring government benefits through those bank accounts to the beneficiaries cannot be seen as complete financial inclusion. What we require is that we are able to break people out of the clutches of rural money lenders and break the vicious cycle of poverty by enabling better livelihoods through their bank linkage. And that is a long way to go in India still. So this in brief, I tell you, this is a big subject which I teach my students. You see, what's happening? Why are people still in this vicious cycle of poverty, especially in rural India, where they are forced to borrow from money lender traders at very high rates of interest, 5 to 10% per month? It's like 60 to 120% rate of interest per annum. Which business in India will give you that return? Nothing will earn you that return. And therefore, what happens is that you get caught in the clutches of these money lenders who are also traders. So the money lender is not only lending money, the money lender also dominates the output market. So when you are a farmer, you produce your output, what you do is go to the market. What the money lender does is, he says, okay, I will adjust whatever money you owe me against the output that you have brought for me. So you will have to sell it virtually as a pittance to the same person who actually lent you the money. Then that person is also a landowner. He's also a person on whose land you are forced to labor. Your whole family is forced to labor. Your women are forced to provide sex services to the same money lender, trader, landlord nexus, and you lease your land to the same group of people. And finally, actually, the goal of this entire exercise is that your land itself is lost. The land, which is the foundation of your livelihoods in rural India, you are compelled in distress to overcome your debt, which is so enormous that you can never overcome it in the credit market, the interlocking of all these modes of exploitation actually ensures finally that you lose your land. So land alienation, dispossession of India's peasantry, and the impoverishment of India's farmers is what happens because of the operation. The linchpin of this whole process is the credit market, where you charge such high rates of interest. So what should we do now? I mean, look, I am saying privatization will be a blow to what I'm about to describe to you, because what is the way out? I'm not saying that public sector banks are working exactly the way they should. No. And the reason why people are clamoring for their privatization can be understood. Because the public sector banks, which were operating under the policy, what is called the policy of social coercion. See, the policy after nationalization was that you must lend to the poor in areas which are unbanked. So lend to people who have not had access to formal credit at reasonable rates of interest. But because it was all target-driven, coercion-driven lending, what happened was that the banks were making huge losses, and the entire functioning of the public sector banks was becoming unviable. So after the economic reforms were launched in 1991, very strict profitability norms were applied to these public sector banks. What that led to is that many of these banks shut down their branches in remote rural India because they were all making losses, because people were not being able to repay the loans that they were getting from the public sector banks, because this was all mindless lending. It was lending happening under coercion by the Reserve Bank of India, that look, you have to do it because the Prime Minister has said so. And that is not a way in which banking can ever operate. And in fact, what happened therefore was, as the public sector banks withdrew from rural India, the money lenders again made a comeback. It is only in the 21st century that a new beginning was made by public sector banks in India, when a relationship was built between public sector banks and women's self-help groups in the remote rural hinterlands of this country. What happened now was that a way was found where people could get credit at very reasonable rates, at low rates of interest, but the bank's profitability was also ensured. And how did that happen? Because the women's self-help groups ensured that the lending that happened was done on a very sound basis. See, what happens, what Stiglitz was saying, why can't banks lend to so many million borrowers? Because banks find it very hard to get the economic intelligence. You need to know about your borrower. When you lend money to people in rural areas, you need to know their capacity to repay. If you don't know that, you will make loans which will never come back. And that is what was happening. People were being declared as defaulters. Banks were running into losses. But once the women got linked to the banks, the women SHGs provided that information. Those transactions costs which Stiglitz was talking about were reduced, and proper lending happened by the public sector banks to people who had no access to formal credit before that, and the loans came back to the banks. So the lending happened on a sound economic basis. It was a proper business proposition for the public sector banks, and the profitability of many public sector banks improved because the lending that they did was on a sound economic basis, and the money that they lent came back to them with interest to the extent of 95 to 100%. The loans were repaid by the women's self-help groups. So the impeccable financial discipline and extraordinary repayment record of the SHGs enabled actually the banks to improve their condition. So it was a win-win. Banks became profitable, and the people who didn't have access to formal credit got access to credit at very reasonable rates of interest. And I have been involved in this process along with thousands of organizations working in this space all over India. So the important point to recognize is that it is not social coercion, not even corporate social responsibility, which is the new buzzword, that we must be do-gooders, and out of the goodness of our heart, we should do things for the poor. What is driving this SHG bank linkage program, as it is called, are the robust business considerations of public sector banks. Once it becomes a sound business proposition for the public sector banks, then they are happily lending. And the Vijay Mallya's and Subrata Roy's are running away with their money, but the poor in this country who have no other choice but to borrow from the public sector banks, they are very rigorous, very impeccable in their returning the money that they borrow. And so my worry is that if we start privatizing these public sector banks, then what will happen to the most powerful instrument in India's battle against poverty, especially in rural India? That instrument could get deeply compromised. Because, I have actually tried to work with the private banks also. The Axis Bank Foundation is a great philanthropy with which I have had years of working experience. So the Axis Bank Foundation, which is of course the CSR part of the Axis Bank, urged us to actually explain to the Axis Bank, which is a private bank, that they would benefit if they joined up with our women's SHGs. We tried very hard, but after all, a private bank is there in order to make profits for its shareholders. And unfortunately, none of them were willing to contemplate lowering the rate of profit, which they would have to do if they came to our areas. They could charge much higher rates of interest in the areas where more well-off people live, and they are their borrowers. So essentially, private banks are not willing to go to the remote areas where public sector banks are going and are flourishing today. And the entire impetus to universal financial inclusion, which is only halfway there, as I told you earlier. The FI index is only 53. Today, we need to deepen financial inclusion in many parts of India. And so by privatizing, we could actually completely impede this thrust towards financial inclusion. And so what I am arguing to you today, and I am arguing with the government, I'm telling them, rather than privatization, what is urgently required are reforms to improve the quality of the public sector bank relationship with SHGs, with much greater state support to the SHG bank linkage program. This will enable this program to reach a critical mass, which will tackle the root of the problem, which lies actually, ironically, in unregulated credit markets. So instead of trying to get the state out of the credit market, I'm saying the state must enter into the credit market in a way which respects the autonomy of the public sector bank. So what I'm arguing for, therefore, is major regulatory reform in banking in India. We need reform. I'm not denying that. But I'm saying don't throw the baby out with the bathwater. I'm saying retain the public sector banks, but the way you regulate them must change. So regulators must ensure, and this is a very important new development, the recent mis-selling of financial products, where a product or service is misrepresented or a customer is misled about its suitability, should not be repeated for the poor, as it will destroy trust and defeat the very purpose of financial inclusion. The basic building block of the financial system, in fact, of all markets, is actually trust. This is, by the way, something Adam Smith has spoken about, the person who is supposed to be teaching us the operation of the invisible hand. In his theory of moral sentiments, he's very clear that without trust, a market economy cannot function. And the government and all financial regulators must work to protect investor confidence as the project of financial inclusion moves forward. Those arguing for their privatization overlook the fact that many of the problems facing public sector banks have arisen because of a fundamental shift in the thrust of economic policy in India over the past 30 years, indeed across the world. And I just want to end by explaining to you how this new focus, which is on monetary instruments, has actually led to this problem arising. See, what Keynes talked about and what happened in the golden era of capitalism from the 1930s to the 1970s was that the state played a major role in giving fiscal stimulus to the economy. So what the state did was invest in very critical areas of infrastructure where the economy needed a kick-starting. And that was the key role that the state was able to play in order to support the capitalist system in moving ahead. But what has happened in the last 40 years is that there has been a fiscal conservatism. What is called the policy of austerity has taken over, and the primary role has been given to the banking system, that banks must actually provide the stimulus to the economy. What should they do? They should lend to the market and do it on terms that will enable infrastructure projects and other projects to come forward. So what has happened in India? Public sector banks have been repeatedly forced into populist measures such as loan waivers. In the 1980s, they were called loan melas. Now they're called waiving the loans which the farmers have taken, or financing infrastructure projects without requisite due diligence, which have damaged the integrity of the banking system. So you're forcing banks to actually do things like loan waiver or finance infrastructure projects without any understanding of the amount of damage they do to the very integrity of the banking system. And what has this done? A lot of non-performing assets have entered the balance sheets of the public sector banks. And then the bank is blamed. What is happening is political interference of a kind which should not happen, which is destroying the autonomy of the public sector bank, which is not allowing the public sector bank to operate in a professional manner. And because of that, the balance sheet is going into red. And then we are saying that it's the problem is with the fact that these are public sector banks. So real public sector banking reform will lie in giving them greater autonomy and professional capabilities rather than their privatization, which could well be a disaster in the making. These are some of the references which you should look up if you're interested in going deeper into the subject. But this is what I wanted to talk to you about today.